All right, everyone. Thank you very much for joining us today for an interesting new segment in our educational webinar series for retirement plan survival skills. We're going to cover a few different topics today of the diversity that you can actually get into with self-directed IRAs and qualified retirement plans. So we're also going to touch on the employer type plans. We're going to touch on some more exotic alternatives that just go past the standard real estate and lending and some other things. Really kind of explore what diversity looks like, past just investing in equity markets and things that are on stock exchanges. What you can expect to accomplish by taking back that control and actually having the options to invest in things that you know and understand, or maybe things that you'd like to learn more about that you'd be interested in investing in as well. My name is Alex Perny. I will be your moderator today. I'm a certified IRA services professional here with Advanta IRA. I've been here since 2012, the beginning of it. So I've been doing this for a while now, and I've seen quite a bit. I would like to make sure that everyone knows if you have any questions, please do type them into the chat box. All raised hand functions and speaking for any participant has been muted. So type them into the chat box, even if it doesn't necessarily pertain to a slide or something that we are directly covering in this presentation. I'm always happy to answer those questions because it may ultimately help to enhance the presentation itself and also might help the other participants as well. So make sure you get those questions in. If you have any of them, just type them away and I will address them as they come up. Thank you very much. Now, as always, before we start doing any type of educational information, we need to make sure that we disclaim where this will and won't cover. Advanta IRA and our employees, we do not provide legal, tax, or investment advice, nor do we endorse or promote any investment products. All information and materials here today are for educational purposes only, and of course, all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial or investment arrangement. If you have any questions after this, always feel free to contact me directly or just give us a call directly, and we will be more than happy to answer those questions. If you can't get them into the chat box or you think of something, our consultations are always free. So please don't hesitate to pick up the phone and call us. We were always happy to schedule those and get you in to get those questions answered. A little bit about us for those who haven't had any direct experience with Advanta before. We are a full-service self-directed IRA administrator. We handle any type of self-directed asset that you can think of in many different scenarios as well. We have well over 20 years of combined industry experience. We make sure that we spread out all of our clients' holdings and cash pursuant to best practices and hold all cash for our clients in FDIC insured accounts. We just passed a fun milestone for our business and client purposes. We just surpassed $1 billion of assets under administration here, so we are very proud of that as a testament to our client base and faith in us that we have been able to achieve that as well. And we also have a dedicated account manager program here, meaning that no matter what size of account you have or your activity or anything that you're doing, everyone from a $1,000 account to a $1 million account has a dedicated representative here at Advanta to help you navigate the waters of self-direction, to answer all of your questions, do all of your investments, and all of your bookkeeping for your account. You always have a dedicated representative, so there's no calling into an automated phone bank, getting different people for different things. You always have the same person to go to. So a program that we're very, very fond of and very proud of, and we hope that if you are using our service that you're happy with it, and if you're considering our service, that it would be a point to use when looking at us to differentiate our services. So what is a self-directed IRA? When looking at it in the context of what you need in order to navigate the waters of retirement and what needs to go into that survival kit, a self-directed IRA fits into the section of your retirement planning when you're looking at something to help give you more alternatives, to help give you more diversity. You can only get so diverse when you're looking at equities products or securities products. When you pick something off of a stock ticker sheet, or you're looking at something that is always going to be tied to a particular exchange market, you can only get so diverse. Even if you're looking at different asset classes, things from exchange traded funds to mutual funds to individual stocks to bonds to treasury bills, they all kind of operate under the same auspice of things that are readily tradable security assets. So what this allows for you to do is it allows for you to pick the investments that you more readily know, that you maybe have better better control over, or maybe actually want to invest in tangible assets. It just means that you have the control over what IRA investments that your IRA makes. You are the one that is going to be doing the due diligence, that's going to be making those selections, and ultimately going to be making the decisions that are going to help benefit you later on down the road. And these types of accounts can acquire all manner of assets, real estate, mortgages, private placements, metals, foreign currency, and many, many more things, which we will get into today. So it's important to understand the building blocks that go into what a self-directed IRA is in this context and what it's ultimately going to allow you to do in retirement as well. Now, going off that premise of understanding the building blocks of this, that's where we're going to start. We're going to start with the types of accounts. So understanding what type of account ultimately is going to best benefit you is incredibly important in figuring out what you need for this survival kit. What do you need in retirement in order to better weather the waters of what's going to come at you once you stop working, once you stop earning money, and to help you avoid falling into that trap of only living on a small fixed income. So the important thing to understand is there are many options out there. And oftentimes people have more than one good fit for them. You don't just always have to say, well, I only can do this investment in this type of account, or I can only qualify for that type of account. And it's typically with regard to age as well. So what we're going to start from left to right and kind of work our way over. The most prevalent type of retirement account out there that individuals hold is going to be the traditional IRA, namely because it is what gets a direct rollover from your employer-sponsored plans, such as your large 401ks, your defined benefit plans, your other type of governmental pensions, because it can take in funds tax deferred. So you don't have to pay any taxes going from that. It's going to keep you from having to pay taxes and penalties if you stop working or are no longer employed by that employer. So the bulk of the assets are going to be going into that type of plan. So understanding that is the most prevalent, but not necessarily always the best fit. Now, the traditional IRA is great because it allows you to take a deduction for all the money that you're adding into it, and then everything growing tax exempt until you take money out, in which case you're only going to be paying the proportional taxes of that distribution to your marginal tax rate, meaning that when you take a distribution, let's say in retirement, you take a $10,000 distribution, that's just factored in as $10,000 of additional income, and you pay taxes on it accordingly. The nice thing is that just like with any of these accounts, the growth of the accounts are not taxable. So it doesn't matter if it's traditional, Roth, SEP, Simple, or any other type of account that's enumerated up here. The earnings that you get during the life cycle of the account, there's no taxes associated with it. So all of these accounts get to avoid capital gains. All of them get to avoid ordinary income from any type of income that's generated by a type of asset. So the ability for them to avoid a lot of taxes is the same with regard to the type of plan. The main differences between most types of retirement plans are whether or not you're getting a deduction for adding money in, so understanding your current need for a deductible contribution, and then whether or not you're going to be paying taxes in retirement, meaning that when you take that $10,000 distribution, are you going to be paying taxes on it? Now, a lot of people might assume that the need to choose one of these plans for that is going to determine the type of investment that you can do, which is not the case. All of these types of plans can invest in the exact same type of alternatives, have the same wide variety of things that they can invest in. Some people might think incorrectly that you need a Roth IRA in order to invest in things like real estate or private placements. That's not the case. So with the Roth IRA, the nice thing is that you don't get to take the benefit is that you're not paying taxes in retirement, although you are not getting a deduction for the money added into it. Now, these are going to be a little bit less common because there aren't as many types of Roth employer plans as there are deductible basis contribution plans such as 401ks and defined benefits and larger pensions. But the Roth IRA has a great place in this whole scenario because it allows you to get completely tax-free returns. So if you're not taking a deduction and you're letting that money grow, essentially you're front-loading and paying the taxes up front, and then you're not paying any taxes when it comes out, again, that is a very good benefit. And the other nice thing about a Roth IRA is that there's no limit on when you can open one. It doesn't matter if you are working and getting earned income up until the ripe age of 90, you can always open a Roth IRA and contribute it so long as you have earned income. The traditional IRA does have a phase out where you can no longer contribute to that plan after the age of 70 and a half. And the other nice thing about a Roth IRA is that you don't have to take required minimum distributions in retirement. So let's say you're someone that maybe doesn't have a large sum of money, but you would like to make sure that you are saving for retirement, getting those good tax benefits. Well, if you're going to be forced to take money out and maybe you're still working, maybe the Roth IRA is a better idea for you. Maybe it's going to be a good thing to keep in your bag as opposed to the traditional IRA because of those abilities to contribute and not have to take required minimum distributions. There are also a myriad of different benefits to both of them with regards to estate planning and how your inheritors will ultimately have to pay taxes on those as well. We teach whole seminar presentations just on that. So just understand that the ability of those traditional and Roth IRAs to ultimately benefit you differently in retirement and after you are gone to benefit your inheritors is something to look at when trying to figure out which one's a good fit. Now, the individual accounts are typically going to be based on your traditional and Roth IRAs. Now, sole business owners, individual investors, and people that are generally considered self-employed or that have small businesses might qualify for different types of plans. Oh, and before we get off traditional and Roth, the annual contribution limits for those two are either going to be $5,500 or $6,500 per year, and you have to have the earned income to support that. However, the earnings on those are unlimited, and rollovers and transfers do not count against your ability to make a contribution. So let's say you rolled over $100,000 from a 401k to a traditional IRA, you can still make your $5,500 or $6,500 contribution for that given year. Now, the individual investors that maybe want to have a leg up or maybe have a little bit more options to the types of plans that they have are going to gravitate typically towards the SEP, simple, and individual 401k plan. The simple IRA is a little bit more of an antiquated plan for employers. It allows you to maybe select or deselect if you have employees of whom you aren't going to offer that plan to. But the more prevalent plan for a small business plan that's going to allow for much higher contribution limits than the traditional Roth IRA are going to be the SEP IRA and the individual 401k plan. The SEP IRA allows individuals that have a qualifying business with under 100 employees to either have to contribute 25% of their annual compensation not to exceed $55,000. So if you are someone that owns your own business or you are self-employed, your ability to kind of actually get a lot more money into these plans and create a lot more deductions is going to be much greater than those people that are working for a corporate job. So understand that if you don't have the benefit of having a corporate job benefits package, you still have the individual ability to create a lot of contributions to deferred taxation plans and things that are going to allow you to get a lot more creative with the amount of deductions that you create. So with a SEP IRA, you are creating a deductible contribution. You are not paying any sorry, some people are indicating that they're having audio issues. One moment. Okay. So with the SEP IRA, you do get to create a corporate deduction in the amount of the salary deferral. So if you are a sole proprietor or you are filing as a sub-S, it's going to allow you to pass on significant tax savings to yourself personally. Now, with the individual 401k plan, the nice thing is that you can create a Roth portion of this. So you can have a deductible or non-deductible contribution to it, indicating whether or not it's going to be Roth or traditional basis in that plan. The nice thing is with this, you get to create a direct contribution to yourself that is going to be deductible if you are doing a traditional plan in the amount of $18,000 for individuals under the age of 50 and a half. And for those over the age of 50 and a half, you get an additional $6,000 catch up. So you get a considerable amount of additional money to put in there. You also get to contribute a portion of your profits into that plan. So the net operating income of the business or the activities that you're doing can be contributed into that plan up to $35,000, not to exceed 20% of the net operating income as well. So it's important to understand that when you're trying to figure out what is going to be the best fit, you need to look at not only how much money you want to put away, but how are you earning money? Are you self-employed? Are you a sole proprietor? Do you have a business that would qualify for a business type plan, allowing you to put much more money away? These are all questions that you need to understand before you choose a plan. Now, when throughout this presentation, if I refer to a employer plan, we're going to be referring to SEP IRAs, simple IRAs, and 401k accounts. And understand that all retirement accounts are not created equal. So your ability to administer assets in a different fashion, your ability to contribute much higher amounts than the traditional Roth IRA are going to change depending on what type of plan that you actually end up going with. Your 401k especially is going to allow you a much greater degree of administrative possibilities, i.e. in that you are the trustee of that plan and you can self-administer those assets directly as opposed to having to actually have an administrator like Advanta be directly involved, like you would in a SEP, simple, Roth, or traditional IRA in some form or fashion. So the ability to create differing degrees of involvement for you is going to be much greater with some type of retirement plans. Now, understand that the deductions are going to change as well between the plans. So depending on your current personal taxation needs and the potential taxation that you're going to have in retirement is ultimately going to determine which one of those is a good fit as well. Okay, so just understand that there are a myriad of different ways to go about this. I always encourage people just take a long look at how you're earning your money, and also understand if you are self-employed but are covered, but you are employed by, let's say, a large company but also have a side business, that if you are not covered under an employer plan in that business, you can establish a business plan for yourself and make those higher contribution limits to it. You just need to make sure that you are earning money commensurate with the types of contributions that you're making into that plan as well. And just to kind of enumerate it a little bit better, the difference between the traditional and Roth IRAs that they are individual plans. So when you're looking at this, understand that there are some plans that are strictly going to be just for you as an individual, and there are going to be ones that can be used for a business. Now, depending on how many employees that business has, is going to determine ultimately which one is going to be the best fit for that. So for everyone that is kind of following along, if you are looking at it, and this will be on the YouTube that is being put up as well, the contribution limits that you need to understand for the Roth, traditional, SEP, simple, 401k, ESA, and health savings accounts are all going to be enumerated right here on this slide. So it's a good one to take a snapshot of. Again, it will be on the YouTube if you have any questions as well. So again, please make sure that you get your questions in here. I am happy to answer them because now we're going to be shifting gears a little bit and getting into the types of investments that can ultimately help build these retirement accounts as well. So by large margin, the most common asset that we administer is real estate. So typically when a client comes to us, they are, and I would say about 70, maybe 65 to 70% of the clients that come to us are going to be investing in real estate in some form or fashion. Now, this doesn't just have to be buying a rental property or buying a fix and flip. You can get involved in all sorts of different types of real estate. We have clients that buy land leases. We have clients that buy vacant lots for building or selling. There are a myriad of different ways to get involved with this. Real estate being a tangible asset, a lot of people like it for the diversity fact for putting together a retirement plan that is going to give them something that, no matter what happens in the markets or what happens in the world, that there will always be a tangible asset. It's even if the house gets wiped off the map, there will still be a piece of real estate that their IRA owns. And it's very attractive to a lot of people, although it is not for everyone. There are inherent risks that come along with every type of asset that is on the screen right now. So just understand, just because it's a good fit for someone and it's a large part of what we do, doesn't necessarily mean that it's any better or worse than any other type of investment. So Bill asked, what are the age limits to participate? Ultimately, it depends on what type of plan that you are going to be establishing. If you are still employed or you're still creating earned income from a self-employed business, you can still participate in a retirement plan for that business. If you are still making money, making earned income, you can always contribute to a Roth IRA. Really, the only one that has a phase-out contribution limit is going to be the traditional IRA, which after the age of 70 1/2, you can no longer contribute to, but you can always still use it. Just because you reach maybe a certain age with regards to a traditional IRA does not mean that you cannot still continue to invest, continue to make money. There is going to be any type of restriction on that. I have clients that are well into their 80s that are still buying and selling properties in their traditional IRAs. Granted, they cannot contribute any money into them, but all of the profits and everything else that is generated from those types of assets is going to go back in tax exempt, and they're only going to have to worry about taxes when they take out a distribution from those traditional IRAs. So although it is kind of commonplace in the retirement planning industry to kind of think that you have age restrictions on when you can do stuff, really age is only a number for the most part. If you have the desire and have the ability and the willingness to get out there and get involved in alternative assets and get involved in things that you better understand, typically there's always going to be a way to make that work. So again, real estate being the primary investment goal of many of our clients for the fact that it is tangible and offers them a much wider degree of diversity than would otherwise be attained by just utilizing stocks and equity type investments. However, again, it does involve different issues, namely liability issues. With a piece of real estate, you're going to have to carry liability insurance. There are things that can inherently happen when you own a house that can potentially generate lawsuits and liabilities. So making sure that you have, your IRA has proper coverages and those kind of things with regards to insurance and things are taken care of is paramount with a real estate investment. And in a few weeks, we're actually going to have one of the vice presidents of REI Guard, a national and real estate investor insurance broker, come on to talk to us about some of those issues. I believe that's going to be September 19th, so a good one to check back in for. And then for clients that are maybe looking to diversify a little bit more by still having a secured interest in real estate, a lot of clients will gravitate towards lending for real estate. So instead of buying the real estate directly, they will lend someone the money to then in turn go out and purchase real estate and then hold the note and mortgage in their IRA. So instead of John Smith going to a bank and getting a loan for the purchase of a piece of real estate, they go to Brenda and then ask for the money from the IRA. The IRA makes the loan, they buy the property, and then instead of John Smith making payments to a bank, it makes the payments back to Brenda's IRA, and then she collects the principal and interest income from that note. And again, there's a huge degree of flexibility with this. You can write in prepayment penalties. There can be points collected up front for any type of agreement that's coming between the two parties. The only thing that you really need to have a good grasp on is one, making sure that typically you are not lending to an owner-occupant. If you do, making sure that you're going to a licensed mortgage loan originator to qualify that individual borrowing the money. And two, making sure that you don't run into any usury laws with the particular state that the loan is being made in, meaning that you're not charging too much interest to get into some of those issues. But again, the nice thing about the notes and mortgages is that it will allow you to mitigate some of that risk that you see from real estate. The owner of the real estate is the one that has to worry about the liability issues for the most part. The note and mortgage holder are not the ones that get sued if there is a trip and fall or other libelous action on real estate for the most part. Again, making sure that you check with any type of legal counsel before you get involved in any of these types of investments is absolutely paramount. Now, there are different ways to hold these different types of assets. We have clients that hold them directly in their IRA. Some clients elect to form an LLC that their IRA owns and then purchases the real estate or then lends out the notes and mortgages. This is a way that a lot of clients see to gain a little bit tighter control of their funds, where they will form the single member LLC, their IRA will be the sole member of it, and then they as the client will manage that checkbook. A lot of people refer to this as checkbook control. If you're doing some research, that's typically the keyword that a lot of people use to look at the single member LLC route of doing things. It has its benefits, it has its drawbacks. Big benefit is you do have tighter control. One of the downsides is that then you are in turn responsible for a lot more of the record keeping and compliance for that type of investment that you're doing ultimately without having Advanta directly involved. So just understand that there is a trade-off for doing things like that. One of the more innovative things that clients are doing now is investing in cryptocurrencies. And one of the big benefits to utilizing an IRA with cryptocurrencies is that with the current tax law changes that affect the tax lot accounting for the taxation of trading cryptocurrencies, namely that you have a lot more potential taxation for doing this, doing it within an IRA helps you to get rid of all of that current taxation because you don't have to track the underlying purchase and sale prices for the purposes of determining how much taxation you're going to see on that. So doing it within an IRA can offer a huge tax benefit if it's something that you're interested in. Obviously, it's not for everyone. It is definitely going to be on the end of the end of the spectrum that has a lot more speculative and potentially a little bit more risk, but it's something that is available to do within a self-directed IRA. So allowing you to, again, to diversify more, to get more options, to potentially get into things that can make a lot of money while having to not pay any taxes for that is a huge benefit. And ultimately, there are different ways to hold cryptocurrency. You can do it within a single member LLC if you'd like to do direct trading, or if you'd like to buy and hold it and not go through the additional steps of utilizing an LLC, we at Advanta have the procedure and the security to actually hold it directly for your IRA, just like we would a note, mortgage, or real estate in secured offline storage. So if it's something you're interested in doing, we have the ability and the willingness and the ability to do that for you. And then rounding out some of the additional things that clients, we typically see. If you'd like to do foreign exchange trading, we can hold those types of accounts. And then people that like to invest in startup companies or other types of ventures for people that need capital or maybe getting in before a company goes public, you have the ability to hold private stock within your IRAs here. We have seen everything from public supermarkets to Starbucks to Wawa gas stations investments through these IRAs. So just because there's a certain way that someone's offering something does not mean it's going to predicate it against being able to be held in an IRA. If you bring it to us, we can typically make it work. So just understand that just because something might sound, for lack of a better term, exotic or not in the norm of typical investing for what you would think of with an IRA, always bring it to us if you're interested in doing it within an IRA, because we can typically work through the minutia of what they're doing and make it so that you can actually hold that type of asset and get the great tax benefits of an IRA with that type of investment as well. Now, with talking about the possibilities, we have to talk about the restrictions. When you're putting together a toolkit for making sure that you have a good, solid retirement plan and something that is going to go into this survival kit to help you later on in life with retirement and your planning, you have to know what you can't do. Although the options far outweigh the restrictions, understanding what those restrictions are is incredibly important, because if you do violate any of those, the potential for very large IRS penalties is quite present. So the two things that you cannot invest in are going to be life insurance products and collectibles. So anything that derives its value from inherent subjectivity. Obviously, everything is going to be subjective as to what its price is, but what the IRS is referring to in this instance is going to be things like artwork, stamps, coins, antiques, rare bottles of wine, baseball cards, things like that. Now, the reason I do have an asterisk next to coins there for those of you that are looking is because certain types of coins are allowed in an IRA. So if you're someone that wants to invest in precious metals, you can buy precious metal bullion coins that are issued according to a certain standard of fineness. Typically, those are going to be ones issued by governmental agencies, so things like the Canadian Gold Maple Leaf or the American Golden Buffalo. But the types of coins and types of metals you can buy are going to be platinum, palladium, gold, and silver. So if you're interested in one of those kind of things through an IRA, you can certainly do it. But again, it cannot be a rare coin like a 1923 a gold Liberty or something. I might have completely made up a coin there, but those kind of things are not allowable. Trissa asks a great question, and it's a fantastic segue into our next slide. Can you lend money to your own children through an IRA? Unfortunately not. You cannot lend or directly deal with anyone that is going to be considered a lineal descendant or ascendant of you personally. What does that mean? Well, it's kind of a fancy way of saying if you drew out your family tree, anyone that's directly up or down from you is going to be disqualified from being able to invest directly with. With that said, you can partner with these people to make new deals happen. So let's say you and your wife's IRA or spouse's IRA want to go and purchase a new piece of real estate, but your IRA and your spouse's don't necessarily have enough money to wholly purchase it. You can divide it between the two accounts and then purchase it with your IRAs, each owning a certain portion of interest in it. You can apply that same principle to lending someone money or buying some private stock or participating in a private placement. So just understand there's typically a way to make things work with disqualified persons. The only way that it is kind of across the board not allowable is directly dealing with one of them, i.e. lending a disqualified individual money or buying a an asset from a disqualified individual. A good example is that you could not lend your children money for the purchase of a new house. But the interesting thing with these rules is that you can directly deal with siblings. So a sibling is not considered a disqualified individual pursuant to IRS regulations, meaning that if your brother or sister owns a piece of real estate, you can buy it. The biggest thing that I recommend to anyone that is going to be dealing with a family member such as a brother and sister is that you absolutely, and I cannot stress this enough, make sure you're dealing with them on a fair market value basis. If the property is worth $100,000, do not pay them $200,000 for it. Conversely, don't pay them $20,000 for it. Make sure that you're dealing with these people on a fair market value basis, because although the IRS does not disqualify you from dealing with them, they certainly would have an issue if there was a egregious difference in fair market value price for you dealing with them with a qualified plan. So just understand that as a very important aspect if you're going to be dealing with someone that is going to be close to you in a familial relationship. And to kind of enumerate better what it means to not deal with a disqualified individual, and how Advanta can actually help kind of avoid those things. I had a client that had two daughters, and one of them was going to Auburn University. He saw a good opportunity to buy a rental property in Auburn, Alabama, purchased a rental property, and then sent us a lease, and we noticed that his daughter's name was on it. That is kind of another way that you can get involved in something disqualified, is that you cannot directly benefit a disqualified individual as well. We saw that was on the lease, we asked him about it, and ultimately we made sure that did not go through and didn't cause an issue for his IRA. But it's not just the direct investing with a disqualified individual that can cause issues. It can also be the benefit of your IRA to a disqualified individual, such as renting a property, even if they are paying fair market value rent to a disqualified individual as well, that can cause issues. So just understand that there are two things you cannot invest in: life insurance and collectibles, and there are some people you cannot invest with an IRA. So long as you understand that, you are going to be well on your way to making sure that you don't do anything wrong or ultimately run into any issues, because about 90% of the issues can be mitigated so long as that you just understand that. And then understand that any and all expenses directly related to an IRA-owned asset have to be paid by the IRA. Conversely, any income directly related to something that the IRA owns is collected by the IRA as well. So you're not directly collecting the income from something. It has to go to the IRA first, and then if you need to take it, it can be distributed to you. So now that we have a good understanding of the options that are there for your IRA, what you can't invest in, and then also the different types of plans and what it might mean for you as the individual, whether you're an individual investor, whether you are a self-employed individual for choosing a retirement plan that maybe has higher contribution limits. Now let's get into finding the deal, what it means to buy these types of assets, and what these assets might look like with regards to actual numbers with some case studies. So again, make sure that if you have any questions, type them in. It certainly does help to enrich everyone's experience in this. But if you don't have any, obviously, it is not a big deal. So how do you find these deals? It's nice for the fact that when you do self-direction and you're looking to kind of put together that kit to help you in retirement and to survive retirement, is that you're not just picking stuff blindly off of a stock ticker chart or necessarily relying more so on other people's advice. You're getting to kind of take back that control and directly utilize it in what you're actually going to be investing in. So when you go to find the deal, you get to invest in and with the people you know and in what you know. So you get to use the professional network and the investing network and the things that you've spent a lifetime developing to ultimately help benefit your retirement account. So the ultimate benefit there is that you're not having to go more on blind faith as you would with maybe picking something like a stock or something that you're hoping will do well through the stewardship of its board and employees and everything. You're getting to go out and actually do the research. If you are a real estate professional, it helps you invest in your profession and what you understand, or any other type of thing. If you find something that can make a good return for you, it gives you the ability to exercise that within an account to get those great tax benefits. So again, it's investing with people that you know and investing in what you know that is a great benefit to this, and ultimately how most people find their deals. Unfortunately, there isn't any type of list or kind of message board that we can provide to you with regard to what you can invest in. So understanding that these accounts do involve a higher degree of involvement from you as the client, which some people may not be used to. By no fault of their own, most of the time when people invest with an IRA, it's more of a second thought than it is a primary thought in their mind. It's something like a CD with an inherently very low rate of return, or it's something like a mutual fund, which after you purchase it doesn't involve much action, or if any action on your part. So the shifting gears of understanding that you're going to be more involved with the assets and a self-directed IRA is very important. Something that it might come a little bit of a shock to people that are looking to do this is how involved you might need to be with some of this stuff. Ultimately, we will help you to the greatest degree that we can, but it's important to go into any type of investing situation with your eyes wide open and understanding what is needed and required of you for this. So it's something that I like to make sure is well understood, that not only are you going out and finding the deal, but there is some involvement of you as the client in this as well. So what does it mean for your IRA to buy real estate? It's easy enough to click purchase when you want to buy a piece of stock in a Fidelity account or a Raymond James account. But when you say let's go out and buy a piece of real estate, there's a lot of steps in that. It's not something that's as easy as just going up and buying the piece of real estate off a shelf at a supermarket. It's a tangible piece of property that is going to be relatively very expensive, that is going to involve many different steps with several different people. So understanding what role your IRA plays in this is very important. So, and you can extend this to almost any type of asset that you're going to be buying, because the ultimate basis of what this is for the process is going to be relatively similar. Obviously, the document names will change, and what ultimately is provided as the indicia to the investment, meaning what you actually get to secure the investment, will be different for everything. But with regard to property, the property is going to be purchased in the name of the IRA. So Advanta IRA, for the benefit of John Smith, IRA number 1234, is going to be what the title on the deed is going to read. Conversely, it would also be who the lender on the mortgage would be, or who would be titled on the private stock certificate, or the name of what would own the crypto brokerage account, et cetera, is how the assets are taken, title is taken to make sure that the IRA has a valid claim, and also to make sure all of the great tax benefits are kept in line as well. With that said, because the IRA is on the title of the asset, then we at Advanta are going to have to be signing those documents for the purchase. So understanding that if you'd like to buy a piece of real estate, we're going to need to sign the contract on behalf of your IRA. We sign the settlement statement, tax proration, estoppels. We will make sure that the deed's reviewed, the title policy is reviewed, to make sure everything that goes in for your IRA buying real estate is maintained, and that your IRA ultimately has a valid claim to that. And then understanding that in the end of all this, all of the income, whether that's rental, the equity from the appreciable gain at the sale, all goes back to the IRA or 401k tax-free. And this doesn't matter if it's a traditional IRA, a Roth IRA, a SEP Simple 401k, health savings, or education savings account. There is no tax due on any of the type of income that's generated from these types of assets. Tricia asked a great question. Is there any reason to set up an LLC to buy real estate if you're using an IRA to buy the property? Great question, and there's actually a couple of real-world examples I can provide to you as to when one might be beneficial and when it might not be. So when it might be beneficial is that, let's say you are buying property at auction and you need to tender payment immediately at that auction. That's when an LLC might be very beneficial, because you as the client with that checkbook can immediately tender payment for the purchase of that asset. Or let's say you're doing something and you only deal in real estate investment groups, and you typically go to nighttime meetings and do a lot of handshake deals and get things done after hours. Might also be a great fit for you. But it doesn't necessarily mean that having a single-member LLC for your IRA is going to always offer a benefit. A good example of when it didn't necessarily offer a benefit and was just kind of an additional item for the client to go through the expense and continual process of updating. I had a client come to me. She was interested in purchasing a condominium in a 55-plus community. The HOA paid for a property management service, and they already had a long-term tenant in place. She came to me. She was going to use an LLC to buy the property, but ultimately the need to write checks immediately and have that tight control really wasn't seen with that. It's for us to administer that account and go through the purchase, ultimately saved her a few $100s a year in state filing fees. She didn't have to go get an LLC operating agreement drafted. And it was more or less as turnkey as you can get. As far as I know, the tenant's still in that property, and it's extremely hands-off. So depending on what you're doing is going to ultimately determine whether or not that, going through a different structure, like having an LLC to hold the property is going to tender a definable benefit. But I tell people, if it's something that you want to do, that's the great part about self-direction, is that there's no prescribed method to this. If you want to use an LLC and you want to have that checkbook, and even if you have that condominium with the 55 plus condominium with a long-term tenant, go for it. If that's what you want to do and that's what makes you feel comfortable and you feel that it's going to be the best fit for you, absolutely do it. There is not one prescribed method that makes this work. Everyone's different. So make sure that you're doing something that ultimately you feel is a good fit. Just understand that, and you will typically have a good experience with this. So how does it look? It's easy enough for me to tell you that there is no taxes due or that an IRA buys property, but what's it mean when you actually look at the numbers? So for those of you that are looking at it, here's an enumerated case study of, obviously names have changed, numbers have been rounded, but a real world example of what buying real estate looks like in an IRA. And before I enumerate that for those that aren't watching, Brenda asked a good question. If you start with an LLC, can you go back to just using an IRA? Absolutely. So the client that had the IRA that opened, she didn't actually go forward with doing the LLC. I explained to her all the different ways this could be done, and she ended up not going with the LLC. But let's say she had bought that property with the LLC through the IRA, and she found out that it just wasn't a good fit later on down the road. It's easy. There's still a little bit of paperwork and obviously a little bit of money. You would have a quitclaim deed drafted, moving the property from the LLC back to the IRA, move any cash back from the LLC to the IRA, dissolve the LLC, and you're done with it. So also the good benefit of this is that it offers you a great degree of flexibility. You're not casting anything in stone if you start one way and want to switch. And you can also do this from the perspective if you bought the property and would rather have the tighter control in an LLC, you can form a new LLC that the IRA owns, assign the property to the LLC, and you're off to the races. So in either direction, you always have the flexibility and exit strategy to go back or forth depending on what changes with your ultimate investment strategy. So with buying real estate, in this scenario, John Smith identifies a property being sold at short sale. He has an offer accepted at $120,000. His IRA has enough funds to close the deal, all cash, and the deal is funded and closed by the IRA. So now John's IRA owns 123 Main Street, paid $120,000 for it. In this scenario, it's relatively turnkey. So he rents the property for 2 years at $1,200 a month. So he gets a little bit more than $28,000 over that 2 years in rent. Keep in mind that he's not paying any type of ordinary income taxes on that. It's all going back in tax deferred. He will have property taxes that are due. Buying a property in an IRA does not exempt you from the responsibility of paying local taxes associated with that piece of real estate. You're going to have to pay property taxes. So, you pay that out of the cash flow of the property or additional funds that you have in there. So after 2 years, John decides to sell the property. The market's improved and he decides that he would like to sell it. So in the 2 years, the property has gone from $120,000 in value to $170,000. So he sells it for $170,000. So the difference between $120,000 and $170,000, he gets $50,000 of upside profit. No taxes due on that. And keep in mind that he also had 2 years of $1,200 a month rent going back into that. Let's just call this a perfect scenario. He didn't have any major expenses or anything else like that. So in 2 years, he made $78,000, roughly therein. And now he goes from having just $120,000 in his IRA to having almost $200,000 in his IRA without having to pay any type of taxes on that. So he's not having to essentially do any forward tax planning to say, hey, you know what? Let's say he sold this property in the very beginning and he owned it personally. Well, taking a portion of that money and setting it aside for taxes is definitely probably the best practice way of doing it. With an IRA, you don't have to worry about that. Since there are no taxes due, there are no tax filings or tax returns they have to file for the IRA, you can immediately take that $198,000 and reinvest it into a new project. Buy a house that's going to generate more cash flow, or potentially sell for a higher dollar figure to help you compound those profits much quicker than you would be able to do outside of an IRA. So not only do you get the benefit of being able to buy property and sell property and generate that cash flow without paying any type of taxes on it, you get the ability to reinvest the money that you make at a much quicker pace than you would outside the IRA by getting rid of having to escrow and do any tax planning for that. So there's a lot of different ways to look at potential benefits for this, and buying a rental property and selling a rental property is certainly a great way to see that benefit. Now, for people who don't necessarily want to buy property directly, maybe they're concerned with liability, maybe they understand lending people money better than they do buying property. There are tons of different ways to get involved by lending people money. And by lending people money for real estate, it does not just have to be defined into one or the other categories. You can have anything that works primarily done within an IRA. Keep in mind that the big restriction is just going to be whom you are lending the money to. So you can't lend it to a mother, father, son, daughter, or spouse. With regard to those restrictions, pretty much it's as varied as you'd like to make it. You don't necessarily have to have a secured mortgage when you lend someone money. Although a secured mortgage obviously is going to probably offer a greater degree of security. If they don't pay, you can foreclose on that property, and then instead of your IRA owning or being the lender on a note, it will be the owner of a piece of property. The nice thing about that is you have a good fixed rate of return. You get to kind of set the bar with what exactly you are doing. Stephen, if you can type your question in, I'll be happy to answer that, as all of the audio is muted. So just type in the chat box, and I will answer your question if you have one. But you don't necessarily have to do it as secured lending. You can do an unsecured personal loan. Obviously, you're going to get a higher degree of risk if you are not having a piece of security attached to that loan that's recorded in public record, but the amount of interest that you can charge on those is typically going to be much higher. But in the event of default, your IRA is going to have to personally sue someone to collect on that. So understanding that, with the higher rate of return will potentially come a much increased degree of risk. Now, there's also different creative ways that you can do that. People do wrap loans where you have a loan that essentially is going to be encompassing another loan where you're going to be capturing a spread on the profits. You're going to have things where people lend people money, and instead of maybe getting a fixed rate of return, you say, hey, when you sell the property, I get a certain portion of the profits and an equity participation note. These things get as simple or as complex as people like to make them. And this all kind of harkens back to the ability when you're setting up a retirement plan and you're looking, how to best survive retirement. There's not one prescribed method that's going to allow anyone to do it. The ability for a self-directed IRA to invest in things that are a good fit is a huge benefit, as opposed to having to kind of make the square peg fit into the round hole, essentially. You can take it and whatever you best understand and whatever you think that is going to make the most sense for you in retirement, you can make something work with that. And if you understand lending, or you understand real estate, or whatever the inherent investment might be, there's a way to make that work within an IRA. So how exactly does this work with regard to a case study? So the nice thing is that with regard to any of these types of lending that you would potentially set up, there's a different way to do it, and you're also not going to have to pay any taxes with regard to how you set these things up, even if you do have something where you're sharing in the respective portion of profits with maybe a taxable entity as well. Emil asks a question, okay. Okay, who and how do you pay for repair maintenance if you invest in a rental property? Great question. So if you do it directly through the IRA, all you would need to do is just send us a copy of the invoice and we pay it. We pay them same day if we get the invoice before 12 o'clock. If you have an LLC that you own the property through, you as the manager of that LLC would write the check out of the LLC's operating account. It's very simple and very easy to do. If you're local to our Tampa office, we can hold them for pickup, or we'll drop them in the mail to you. And that's all done at no additional cost. So if we're mailing a regular check via regular mail for repair maintenance for a property, it's not increasing your costs to do it at all. So depending on what you're doing, if you're doing a rehab project that needs a ton of work, it's not going to increase your cost. But if you'd like to have tighter control, using an LLC might be a benefit of you to there. So with regard to the case studies, so if you're doing mortgages, Client Sam is a network of investors in Florida. The Roth IRA acts as the lender to these investor flippers. All of the loans are secured by a first mortgage, and they have points up front, meaning that the origination for the loan is going to be recouped by the IRA. So they're charging the people for borrowing the money and then also getting a rate of return on those funds as well. And all of the interest and the points are paid back to the IRA completely tax-free, and then all distributions made to this individual are completely tax-free as well. So everything that is being made in this scenario is completely tax-free, including the distribution, because he's doing it in a Roth IRA. The nice thing is that this exact example can be used in any type of retirement account. The only primary difference is going to be whether or not that distribution in retirement is going to be taxable. So great other thing to kind of illustrate that any of these types of retirement investment strategies can be used in any type of account. You just need to focus on mainly the contributions being deductible and the distributions being taxable, and whatever you feel is the best fit can work within those types of accounts. Now, one that I find particularly interesting is the increased propensity for people to do equity participation. There's a lot of speculation that can be gone into why this is getting more popular. I think that with properties getting more expensive, people are needing to utilize more of their money, and the ability for them to make payments might be a little bit restricted. So allowing for people to not maybe to have to make payments on a loan in lieu of providing a portion of the profits at closing is becoming more of an attractive scenario for the real estate investment market. So in this instance, clients Jane and Andy know a contractor that flips properties. They each use their IRA to lend the contractor 50% from each account money for the rehabs. They have a secured first mortgage on the property, and instead of getting an interest payment, so essentially there's no payments, there's no interest on the money being lent out, but the consideration for them lending the money is that when the property closes, they get 30% of the profits at sale. So if he buys a property for $100,000 and sells it for $200,000, they get $30,000 divided between their IRAs. So they're getting a portion of the upside. They're getting to reduce their liability by not actually owning the property directly. So they're getting to participate in the increase in value while not having to absorb some of that liability that goes with directly owning real estate. So again, there's a bunch of different ways to get involved with this and make something work, and also potentially not just limit yourself to what the traditional constructs of a particular type of investing are, by being able to get creative and participating in equity as opposed to just a secured first mortgage, where if that property goes up by 80% or maybe doubles in value, you don't get to participate in any of that appreciable gain. That's the property owner. You just get your principal back plus any collected interest on that note. So again, it keeps kind of coming back, and I hate to kind of keep repeating myself, but it is probably the singular most important part about this, is that understanding that the flexibility of this for you to not only invest in what you know, but also be adaptable to changing market conditions. Whereas an equities market is going to potentially kind of lock you into what the market's doing. If the market shifts a certain direction, and let's say property gets super expensive and people are trying to buy it and need to borrow more money, it's going to create an opportunity for your IRA to lend them money and potentially get a higher rate of return if they're not being able to collect money from banks or other more traditional sources. So the flexibility of this is really kind of key in helping you take back that control and put together a good survival kit for retirement. Okay, Brenda asks, let's see. If you lend money out, then does it become an asset till the money comes back in to you? Essentially, yes. So in this scenario, if you lend someone money, your IRA holds a promissory note. That promissory note can have any different type of term on it. You can have things like just regular principal and interest payments, just regular interest payments, whatever it happens to be, or maybe it could be a balloon note. There's really no prescribed method that is going to be best for that. But essentially, once it comes back, once the note is repaid, then your asset goes from being a promissory note to cash, and then you can redeploy it and make returns on it that way. But in a very simple term, that certainly is exactly how it works. Okay, so looking to the future, the alternatives are certainly going to be as varied as your imagination is. Kind of coming back to cryptocurrency because it's probably the newest type of asset class that we're seeing here, and especially with the recent changes in tax laws, it makes utilizing an IRA to invest in these types of things, if you're interested, very appealing. Meaning that with the recent changes in tax law, if you were to exchange one type of cryptocurrency for another, that now is becoming a potentially taxable transaction. And with the high degree of trading that goes on with this, it can create quite a taxation nightmare or a very large taxable liability for people that are interested in this type of asset. And again, this doesn't mean that you're investing your whole IRA into it. If you want to utilize it as a tool to help diversify things, it certainly is a very appealing prospect. So again, no tax on trading or liquidating. You can hold the crypto directly with Advanta or in a checkbook LLC. So if you want to do it either way, have tighter control or have us hold it directly, we can certainly accommodate that. And there's no limits on the type of crypto trading or earnings with these types of things. So you're not just limited if you're interested in cryptocurrency to just doing maybe Bitcoin and Ethereum. If you're interested in that type of thing, you can get as creative or as mainstream as you'd like. It's just something I like to input in there, although it is quite a extreme departure from real estate and mortgage lending. It is important to understand that we try to make sure that we stay on the cutting edge of what is out there to invest in, so long as it is allowable for our clients to pursue. And then another kind of emerging market that a lot of people have been looking into, especially with the increased cost of real estate and trying to do that kind of thing, is crowdfunding platforms. So there's different types of platforms out there that allow you to invest in a small portion of maybe a large commercial project or a large lending platform that offer maybe small chunks of investments. Maybe instead of having to have the $10 million to buy a piece of commercial property, they're offering it to investors to buy into that deal maybe at $5,000 a piece. So you can use your IRA to invest in crowdfunding platforms. And the nice thing is, with recent tax law changes in the previous administration, the need to be an accredited investor, so that means someone that is accredited with over $250,000 of annual income or over $1 million of trust assets, goes away. So it opens up these larger investments to the average Joe or Jane, if you will. So it's certainly kind of an interesting market that's emerging. So if you'd like to invest in things like with your IRA, we're certainly happy to hold them. And there's very little restriction that is in place on you with regards to that. So long as the crowdfunding platform will accept an IRA investor, we can typically make that work. Jacqueline asks, if you'd like to hold Bitcoin, how do you do it? Again, just give me a call. That essentially kind of does into our presentation. We're hitting it right on an hour. Jacqueline, give me a call or shoot me an email. I am happy to help you through that process. There's a bunch of different ways to do it, and it's going to be particular to exactly how you would like to hold that cryptocurrency as to which direction you go. But again, thank you everyone for joining us today. We had a great turnout for today. I hope you got some beneficial information out of this. If you have any questions, please feel free to give me a call. I'm always happy to help. Shoot me an email, and we're certainly happy to get you the information to help you make better choices. So with that said, I hope everyone has a safe and wonderful Labor Day weekend, and if you have any questions, please let us know. Thanks for joining. Have a wonderful day.